Welcome back to another episode of Map Your Money. I'll be your host today, and it's my first time hosting a podcast, so you can probably feel the extra enthusiasm. My name is Meg Randle, and I'm the Chief Operating Officer at both Benedetti Gooser and Associates and Beam Wealth Advisors. So today we have a fascinating topic to discuss, which is Roth conversions and planning for a tax-efficient retirement. Who better to join us than Arish Nurani? Arish is host turned guest today. So he normally hosts Map Your Money, but we've turned the tables on him. Arish is a certified financial planner and wealth advisor at our firm. So whether you're new to this concept or you've heard about it before, stick around because we're going to break it down for you in simple terms. So Arish, before we dive into Roth, let's kick it off with an icebreaker. So this is a timely topic. What's more timely than Thanksgiving? So what I want to know is, what are your make and break Thanksgiving foods?
Sounds good. Well, thank you for introducing me, Meg. I appreciate that. It's good to kind of be on the other side of the table for once. It's a bit of a switch, but I like it. Good icebreaker there. I'm a big fan of Thanksgiving. We always get the whole family together and have a little bit of, I'd say our Thanksgiving can be slightly different. We have some different foods and add a little bit of Indian and Eastern spice to it. So I think there can be some changes there. But my go-to, my make is definitely still mac and cheese. You can't go wrong. Always been my favorite. I think it always will. It's probably like half of my plate, both servings. So I'm a big fan of the mac and cheese. The break is something that's good, but I always regret it, is my grandma makes really, really spicy turkey. So we'll have this super spicy turkey and then like the regular turkey. And eating the spicy turkey sometimes not ends up being the best decision for me, but I'll have a small bite anyways. But I'd say that's for me. What about you?
Well, as far as breaks go, I think it's just a little bit too generic to say the cranberry sauce. So I'm actually gonna be a little bit controversial here and say it's the mashed potatoes.
Whoa.
I could do without the mashed potatoes, and simply because I'm a raving fan of the yams or the sweet potatoes. So like I'm ready
Fair.
for a little bit of substitution, but make for me is always stuffing. That's where I go wrong. Similar to you, half a plate. So those are my make and breaks.
Sounds good.
All right, Arish. Well, speaking of Thanksgiving, let's get into the meat of our conversation.
Hello and welcome to the Map Your Money podcast, a production of BGA Teams. We exist to simplify the lives of our clients and listeners and help you lay the course to meet your financial goals. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the show was pre-recorded earlier this week.
Arish, let's start with the basics. Can you tell our listeners what exactly a Roth conversion is?
Yeah, definitely. I think it's something that's very timely for us right now. It's a conversation we're having with a lot of our clients as we're getting to the end of the year. But what a Roth conversion is just looking at converting traditional IRA or a 401k that's contributed to pre-tax and taking that and rolling that over into a Roth IRA. And so you'd voluntarily be paying taxes on that, taking it out of this pre-tax vehicle and moving it into your Roth IRA. And so you're voluntarily paying those taxes now to get that into the Roth IRA so that in the future, you don't have to pay taxes on that growth. And so that's the big advantage, even though you're voluntarily paying taxes now. I know that can sound like ridiculousness to some people, but in the long run, in some situations, it definitely works out in the favor of the client or individual.
Elaborate on that for us. So tell us a little bit more about what the benefits would be or why anyone would willingly agree to pay taxes up front.
Yeah, definitely. And so I'm going to use sort of an example. So I'm going to throw a lot of numbers at the listener here, but I'm going to try to make it digestible. So let's say you're going into retirement and you have $60,000, just hypothetically, in an IRA or a 401k, and you're not really planning on using this money, or you know that you have other cash flow or other funds in an IRA or a Roth that you're going to be able to pull out to meet your income needs for the next 5 to 10 years. So you have this extra money in an IRA you're not really going to need in the next 5 to 10 years. And so what you would do or something we could look at doing would be rolling over a portion of that each year. So let's say we do the calculation, and I'll come back to how we get to this number. But let's say we do the calculation and we realize, hey, in your situation, we can roll over 20,000 each year and keep you in your same 12% tax bracket, let's say. And with that 20,000 we roll over each year, we can move that into your Roth IRA. So that'd be 3 years for that 60,000 total. So that would equate to an extra 7,200 that you'd be paying in taxes, 2,400 each year on that $60,000 rollover. But the big advantage of the rollover is that you're not going to have to pay taxes on the growth of that money. And so we're always assuming that this money is going to be invested. And whether it's in the traditional IRA or in a Roth IRA, let's say that it grows at an average of 7% per year. And so over 10 years, that 60,000 would about double. So be at 118,000. And we can dive deeper into all of that. I know we've talked about market returns and how they're up and down and not going to be an exact 7%. But for the purpose of this example, let's say an average of 7% per year. So getting you to that 118,000. So if you didn't do this Roth conversion, you kept that 60,000 in that traditional IRA, you would then have to pay income tax on that additional 58,000 when you withdraw it. So you'd have that 60,000 originally that you already paid taxes on. So that's equal. But that additional 58,000 would still be in this pre-tax vehicle where you'd still have to pay taxes on it. And so that's the huge advantage with the Roth conversion is that you've already paid taxes on that 60,000, and that additional 58,000 of growth, you would then be able to take out right away or keep it in there and let it grow no matter what. You're not going to have to pay any taxes on that. And there's also a lot of benefits if that passes on to your kids and you're not to use it. They wouldn't be burdened by some tax liability there. And so that's the big advantage is you're paying that tax now to where you're able to allow that growth to not have to pay taxes on that growth of that money.
Okay, so put in simpler terms, it's a little bit of short-term pain, so paying those taxes up front for a lot of long-term gain. Am I understanding that correctly?
Most definitely. And it's definitely something you want to look at in your situation and see what your plans are for your income needs. It's definitely not something that makes sense for everyone, but I do think it makes sense for a lot of people to at least look at and consider.
Okay. So you've covered kind of the what and the why of this, but tell us a little bit more about the who.
Yeah. So I mentioned it makes sense for a lot of people to look into it. The point when a Roth conversion makes the most sense is once your tax bracket comes down. And so while you're working, you might be in a higher tax bracket, but then once you retire, you no longer have this income from a job. You're pulling some income from elsewhere, but that's when your tax bracket goes down. And so that's the whole point of using something like a traditional IRA or 401k is that you're putting money away when your taxes are high, so you're not paying that tax, and then taking that money out when your tax bracket's lower. And so in retirement, once your tax bracket comes down, is a great time to look at a Roth conversion. Typically right at retirement is the best time because that's when you still have the option of saying, okay, what are my options for pulling money? How am I going to meet the expenses that I had prior to retirement? Now I don't have this income from a job, but I still have all of these expenses. Where am I pulling that from? And so planning around that is very important. And then while you're in retirement, up until required minimum distribution age or prior to drawing Social Security is also a great time to do that. But just because you're drawing Social Security doesn't mean you're exempt from doing a Roth conversion. You just might not be able to do as much as someone who might not be drawing that income.
Okay. So you've outlined that, this makes a lot of sense for someone whose taxable income has gone down. is this strategy relevant prior to retirement?
Yeah, definitely. And I mentioned kind of when you're going into retirement, you want to have this plan about, okay, where am I pulling this money from? And prior to retirement is when you come up with that plan. And even while you're even further from retirement, you need to make sure that there is a plan in place and that you have different vehicles working for you. And so you want to have these different buckets of money that you're able to pull from in retirement to be able to take advantage of a very tax efficient retirement. And so having the ability to pull from a brokerage account while you're retired to be able to do a Roth conversion with pre-tax money, so that you're able to fully take advantage of that, and maybe you delay your Social Security a little bit further. But the main point is just planning around this. And if you come into retirement with a really good plan, say, hey, for the first 3 years, I'm going to live off of this brokerage fund and we'll be able to keep my tax bracket artificially really low. I'll still have the same cash flow, but we'll keep it artificially really low. I'll be able to convert a ton of money from my traditional IRA or my 401k into this Roth. And then from there on out for the rest of retirement, that money's going to grow tax-free. So around the planning of a Roth conversion is also really important and something that we specialize in as well.
Okay, so it sounds like the planning all happens pre-retirement, and then this is a great strategy to implement post-retirement, but really immediately upon retirement.
Exactly. And it's never too late to start making these plans, even if you are in retirement or retirement's a year away. That's going to sound nerdy here, but that's part of the fun as an advisor is we always come into situations with different individuals who have different things going on, whether it's this income or they have some part-time work or whatever it might be. Everyone's situation's unique. And that's why we want to look at your specific situation and say, okay, does a Roth conversion make sense for this period of time? Or how can we work that into your plan? And what's the most efficient way for us to do that? At the end of the day, not that many people love paying taxes. And so being able to take a step back and say, okay, by moving some money into a Roth IRA, if you zoomed out and said at the end of your life, okay, I saved this much on the total amount of taxes I would have had to pay or my beneficiaries would have to pay, that's a win for us. And I think it's a win for the client as well.
Yeah. I think most of us can agree on that. Or maybe that we don't want to pay more taxes than we have to.
For sure.
But so this strategy is really specific to individuals who are, planning for a retirement, entering retirement. Talk to us a little bit about the different buckets that you want to be planning for as you're maybe further away from retirement and you're doing some of that strategic planning.
Yeah, so I kind of hinted at it a little bit earlier, but if you want to think about an extremely tax efficient retirement, and when I say extremely is because it's perfect on paper, but it never really will work out this well. Like I mentioned, everyone has these different circumstances and different things going on. But if you're able to retire, and so your taxable income will go completely down. Let's say you don't have any income coming in. And you were able to build up a taxable brokerage account. So it's an individual brokerage account. You would be able to pull out from that account. And while your tax rate is low, you have to pay when you sell investments in a taxable brokerage account, you have to pay long-term capital gains on these investments. And so let's say I bought Apple stock, for example, when I was 20, then I retire at 60. And it grew by 40,000. So I bought it at 20,000. I sold it at 60,000. It grew by 40,000. You would have to pay long-term capital gains on that 40,000 of gain. And that rate is dependent on your tax bracket. The very unique part about the long-term capital gains rate is under 89,250 for a married file jointly couple of income, that tax rate is 0. And so you're able to actually pull out a good portion of that money at a 0% tax bracket. And so being able to do that right at the start of retirement for a portion of your income is something that could really go a long way and really take away from these huge gains that you might have in this account and be worried about selling. And so having a brokerage account and setting that up for retirement, I think is a very advisable thing for everyone to do, looking to either retire early or just look at a tax efficient retirement. And another advantage of that is you're able to keep your income lower, thus being able to do those IRA Roth conversions. And so you would be able to pull out a portion from your traditional IRA or 401k in that sense and roll that over into your Roth IRA. And so we'd want to check with a tax expert with all of this, make sure that we're doing this in the most tax efficient manner for you. And more likely than not, you're not going to be able to pay nothing in taxes. And I mentioned rolling over that money from an IRA, you're voluntarily paying those taxes. But while you're voluntarily paying those taxes, we want you to voluntarily be paying it at very low rates, and then being able to pull out all the growth tax-free and the principal tax-free after that. So having those different buckets going into retirement, a brokerage account, that pre-tax money that you're saving through your career, and then also building up a Roth bucket or moving that money into a Roth bucket is very huge.
Yeah. Yeah. So I think those all sound like somewhat simple strategies, but when you get into the weeds, it gets maybe a little bit more complicated. And like you said, we also want to make sure that we're getting tax advice. And so tell me a little bit more about, or for our listeners who might be interested in exploring Roth conversions, how do we help our clients decide how much to convert?
Yeah, so it's a unique software that we've been using. It's called Plan, where we're able to go in and we take a client's tax return from the prior year. And so you take their prior year's tax return and you make assumptions based off of the current year. So right now we're getting clients' 2022 tax return that they either filed in March or with the extended deadline in October. We're plugging that into the software. We're doing some of the inputs and calculations and saying, okay, they're in the 12% bracket with, and I'm using all hypothetical numbers here. Let's say they have 70,000 of income. That puts them in the 12% bracket for married filing jointly. We notice that they can have an extra $19,450 and stay in that 12% bracket. And so we say, okay, now we have this opportunity to move that much from their traditional IRA into their Roth IRA and stay in that 12% bracket. We'd want to add a little bit of room and talk to them about how their situation might be different in 2023 with income. But that really gives us the opportunity to say, hey, they're at this tax bracket. We want to fill up this tax bracket, not go $1 over it, and use all of that money, pay the 12% tax rather than 22% tax, and move that into the Roth. And then we look to do that in the following year, and come up with a plan on how we're moving that money and how their income needs will change in retirement to want to withdraw that in the future.
Okay. I think it's important to note Plan is not a paid sponsor of this program. We're just fans of the software. But Arish, if you wanted to leave our listeners with one thing, what would it be?
Yeah, I think for the listener, it's looking at their situation and saying, okay, does it make sense for me to think about a Roth conversion in my situation? Am I pre-retirement and want to say, hey, I'm building this 401k or IRA pretty substantially. What am I going to do with this money in retirement? Maybe I need to come up with a plan once I retire to say, okay, how am I going to move this money? How do I tax efficiently take this money out? And then if you're in retirement, it's looking at your situation and saying, okay, this is where I'm at with my different income sources. Does it make sense for me to look at taking some of this traditional IRA money and rolling it over into a Roth, voluntarily paying taxes now so that you don't have to pay taxes on that growth of that money in the future? And that's the biggest takeaway now. That is the biggest takeaway, is that it's that short-term paying those taxes now for the ability to not have to pay the taxes on any of that growth in the future. And so that would be my biggest takeaway for you, Meg.
Okay. Well, I think that wraps up our discussion on Roth conversions. Thanks for letting me turn the tables on you today, Arish, sitting in your chair of host. And to our listeners, I hope you found this information helpful, and please reach out to us if you have any questions or would like to dig into this strategy with a member of our team.
Thanks, Meg.
All information provided through this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside Benedetti, Gooser & Associates and Beam Wealth Advisors. All examples are hypothetical and for illustrative purposes only. Benedetti, Gooser & Associates and Beam Wealth Advisors do not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.